Hello everyone and welcome back to Make Money Guide. Given the level of risk associated with an investment strategy that incorporates debt, it's important to consider whether this approach is right for you. Speaking to a professional, such as a financial advisor, is highly recommended. It's also important not to incur more debt than you can comfortably afford to pay back, regardless of whether it's efficient or inefficient. Debt is the dirty four-letter word that everyone is afraid of. There are so many television shows, books and magazines devoted to teaching people about getting rid of debt. While debt can be a negative, it can also be a positive thing if used properly. Bottom line, when it comes to taking on debt, there is always a risk, but if managed well, efficient debt can help you to build your wealth over time. Debt can be used as leverage to exponentially multiply your returns. What is leverage exactly? Leverage is using borrowed money to increase your return on investment. Leverage can allow you to achieve returns that you thought were impossible, but at a greater risk of losing your capital. Today, we're going to be talking about how debt can generate income. Make sure you subscribe to the channel and turn notices on so you don't miss any valuable content. Number 8, margin investing. Investing on margin allows you to buy a higher dollar amount of stock than you actually have money for. Margin is the money borrowed from a brokerage firm to purchase an investment. It is the difference between the total value of securities held in an investor's account and the loan amount from the broker. Buying on margin is the act of borrowing money to buy securities. For example, if you had $50,000 in your traditional brokerage account, you could leverage your investment and open up a margin account. A margin account allows you to only put a max of 50% of the purchase price of a stock. You would have $50,000 in cash, and an additional $50,000 will be loaned to you from your broker. Your $50,000 investment gives you $100,000 worth of buying power. You could use this money and buy $100,000 worth of stock. If the stock price appreciates, then you can pay back the loan and pocket the profit. That sounds great. The negative is that if equality in your account falls below a certain value, your brokerage firm can issue a margin call. What is a margin call? Think Michael Douglas in the movie A Perfect Murder. Your broker can liquidate your entire position in a stock, leaving you broke. Number 7, leveraged ETFs. Leveraged ETFs allow investors and traders to amplify their returns by getting long or short on particular index. Fund companies like ProShares offer leveraged ETFs that let investors multiply returns and losses 200% and 300%. These funds let you invest in specific indexes, bonds, commodities, or sectors. Leveraged ETFs are attractive because of the extraordinary profit potential. During market booms, you can achieve returns with leveraged ETFs that other investors dream about. The problem is that the same way that leveraged ETFs work for you is how they can work against you. Unless you are great at trading in and out of these funds, leveraged ETFs can magnify losses by wiping out your entire investment in a few days. Before jumping onto this ship, you should learn more in dissecting leveraged ETF returns. Number 6, hedge funds. Hedge funds are financial partnerships that use pool funds and employ different strategies to earn active returns for their investors. These funds may be managed aggressively or make use of derivatives and leverage to generate higher returns. As we all learned during the financial crisis, hedge funds are some of the biggest users of leverage. Hedge funds are famous for generating abnormal returns by using leverage. Many hedge funds lever up to 10 times their total assets. Billionaire hedge fund managers like John Paulson have used leverage to turn accredited investors into multi-millionaires. However, if the fund's manager's investment thesis is wrong, this can drive a hedge fund out of business and lose the capital of all investors. Hedge funds such as long-term capital management, which needed a bailout, were levered up to as much as 30 times their assets. Number 5, short selling. Have you ever watched a financial program on television and heard that it's time for you to short the market? Short selling is a popular way of betting against a particular security by borrowing shares from an investor and selling them in hopes that the shares decline. Short sellers like Bill Fleckenstein have made a fortune by properly timing decisions in stock prices. The downside of short selling is that losses are unlimited, which means that short sellers can lose much more than the initial investment. Number 4, currency trading. Currency trading allows investors to control large blocks of currency with a small amount of money. Currency investors can lever up their accounts 100 to 1. The pros of currency trading are that you can take a small amount of money and turn it into significant sums very quickly. George Soros is known as a man who broke the Bank of England, netting $1 billion by betting against the pound. Conversely, currency trading has the potential to clean out a trader's account in a matter of minutes. Number 3, remove inefficient debt. Having inefficient debt is more than likely reducing your wealth due to the associated interest and fees. In some cases, it may be worthwhile focusing on paying down this debt first, starting with your highest interest fee debt, and progressively paying this off. For instance, if the interest on your credit card balance or personal loan is more than the interest on your home loan, depending on your circumstances, it may be better to pay off your credit card debt first, given it has a higher interest and fees than your home loan. By utilizing this approach, you should be able to progressively reduce your overall interest payments. Number 2, borrowing to invest. Borrowing to invest in property or shares, or gearing, can be a powerful means to build wealth over time, as it enables you to purchase more investments than would be otherwise possible. If your investments increase in value over time, gearing can generate a high overall return after the interest and other costs associated with the debt have been factored in. Capital growth and income generated from the assets can also be used to pay back the debt plus interest and fees. The interest charged on the debt may also be tax deductible. However, there is always a risk that your investments may decrease in value, resulting in owing more on the loan than the value of your investment. If you're unable to pay back the loan due to unexpected circumstances, such as an interest rate increase or you're out of work for an extended period, the lender may have the right to take ownership of your investments. In a worst case scenario, depending on the amount you've borrowed to invest, you could lose more than your initial capital. Number 1, debt recycling. Debt recycling can be an effective strategy to accumulate wealth over time by converting some of your debt, which is inefficient, doesn't generate capital growth or income, or isn't tax deductible, into debt that may be efficient, generates capital growth or income, or is tax deductible. One way to do this involves using a lump sum, possibly received from a bonus or inheritance, to pay off your inefficient debt. If you then borrow the same amount and invest it, you're essentially replacing the inefficient debt with a debt that is tax deductible and could potentially generate wealth. There are other options for implementing a debt recycling strategy with varying levels of risk. A financial advisor may be able to help you determine a strategy that is most suitable for your needs. Though, with all that said, the risks associated with taking on debt are still there. Using debt as part of your investment strategy can introduce substantial risk, including borrowing could increase potential losses, your losses could exceed the amount initially invested, the value of your investments purchased using debt may not increase, or if the value does increase, it may not be sufficient to cover the cost of the loan, such as interest and fees. You may need to sell your investments sooner than intended to cover your interest, fees and charges. If you are unable to repay your loan, the lender may have the right to sell your assets to cover outstanding repayments, interest or fees, and you may be liable to pay more tax. While you are here, go ahead and click on one of these 2 videos on your screen. See you there.